Can't complain. Just back in the U.S., back at work, being a new dad, trying to figure it all out. You know how it goes.
Congratulations.
Thank you. I appreciate it. Yeah, it's
Most important endeavor.
Yeah, I know it is. It's incredibly time consuming, but so much fun. So worth it. What's new with you?
I just saw we had a minor green candle, so that's a
I know.
nice thing coming into the week.
Yeah, I think all those people who were saying 48 was the top probably aren't feeling too good with their shorts right now.
Well, I mean, crystal ball, long term, there's a lot of things converging that, are either pretty bullish crypto or pretty bearish kind of everything. So, when things are kind of bullish everything. Hello, hello.
Hey, how's it going? Can you hear me?
Yeah, can you hear me?
Yeah, I was listening.
It just froze in my headphones.
Oh, no worries, no worries.
Yeah, no, I mean, when things tend to be bullish everything, then they're not. I mean, this was kind of the approach we took. Like, for example, I think it was the last March when we had the SVB crisis, the USDC crisis, which really unveiled, basically all the toxic bonds that the banks were holding. So it's not just if SVB went down, that's the majority of the entire U.S. banking system, the community of the regional banks. And that means, if everyone's screwed, then kind of no one is, because it's such a drastic thing that someone has to step in, right? So there's so many macro things kind of converging that it's a good environment for at least Bitcoin to be kind of a safe haven asset.
Yeah, agreed. Yeah, the traditional finance macroeconomics, there's a lot of factors there that aren't looking good for us. That could be, extremely negative, but all that, just like you just said, I was always of the belief that this was going to, as our money gets printed into, worthlessness, that eventually people were going to be looking at Bitcoin and cryptocurrency as a way to actually control their money. So, and not have it, depleted by governments and stuff like that. So it's it's kind of crazy though when you think about how bleak everything looked for a while there, and to see it, to see it taking off like this again.
Yeah, well, I think it's tied to cycles and accelerated by leverage and unscrupulous parties. So flushing that out, we get a new reset. But the question is whether we'll make the same mistakes in industry.
Yeah, always a concern. People are very good at repeating history. So memory is short in crypto too. So we'll see.
Yeah.
It's funny how fast people can move on from losing a ton of money on something and go right back to it.
Yeah, I mean, but it's always, I mean, it's the centralized models and the trust that really broke down, last cycle. And actually, this was one of the big dampeners on the ETF launch, was the FTX estate. The potential, the Celsius creditors need to unwind. Gox, from actually, I think Celsius may be done. I think they're, some people started getting their funds unlocked. Genesis, you still have some Gox. You have, you have all these potential, kind of pending pressures, but those are all linked to centralized trust structures. And I mean, that's the whole idea of trustlessness and decentralization is getting away from this, and that's why I'm very long DeFi. But really, it's still the CeFi rails that your vast majority of people will come in on. And even if you look at the ETF structure, you're going to have most people that are they're not self-custodying assets. All all of the ETF funds are being held by a custodian, so it's not your keys, not your coins, right? Mm-hmm. And that's going to be the norm, and that's going to suck up a lot of liquidity. So, we're doing it again now in the institutional way, which I think will be probably a lot better than maybe the FTX way, but it's a bit of the same, and I would really like to see DeFi kind of ramp up here.
Yeah, I couldn't agree more. I think we've got a exciting, next probably at least 18 months that I think is gonna be really good for everybody in the space, and especially good for mass adoption. It's there's a lot it has to offer that just a lot of people don't know about yet. So I think we're getting there, though. All right. Okay. Well, let's if you're ready, Darren, let's go ahead and launch into this.
Yeah, sure. I'm not sure if you also want to get Dimitar up here, my co-founder.
Yeah, absolutely.
In the audience.
Let me bring him up here. I sent you an invite, Dimitar. Let me know if it goes through. Sometimes it doesn't. You might have to request.
I see some familiar faces in the audience. Dow Chemist.
Yeah.
Marco, one of the Iporians. Hello, guys. All right, let's jump in.
Yeah, absolutely. All right, yeah. So if you want to go ahead and kind of introduce yourself. Thanks for joining, Dimitar. Do a little intro and background on kind of yourself and the team.
Okay, cool. So my name is Darren Kemis. I'm the CEO and co-founder of Ipor Labs. And here you have my co-founder, Dimitar. So maybe, Dimi, if you want to introduce yourself quick, and then I'll give a big kind of brief rundown of the team.
Yeah, sure. Hi, everyone. Dimitar here, Chief of Strategy, Tokenomics, and co-founder of Ipor. Been in the industry for about 7 years now. Have been working mostly on building exchange products, centralized exchanges at first, and later decentralized exchanges. Really into DeFi for the past 5 years. And yeah, that's about it.
All right, and Dimitar and I, we go way back. I think now 2018. And so yeah, I've been building in crypto since 2011. A very kind of crazy both trajectory and kind of view to the past and also view to the future. And I think kind of this long-term view is where Dimitar and I really connected. If you think of the rest of the team, I won't touch on everyone. We have a sizable team with a lot of specialties, but we have a very strong team with background, especially in in finance and economics. And I think this is really important. Finance, economics, and mathematics. So this is really important, of course, when you're building DeFi and you're building something like derivatives, because that's the core of the protocol. So we have 3 PhDs on the team. We have people that graduate, with math backgrounds, done their doctoral thesis on elliptic curves. I've set up a trading desk, worked in hedge funds, built for tech startups, payments, banking, insurance, and so yeah, really deep, diverse background, kind of across the full stack. As Dimitar mentioned, he's on the tokenomics side a lot in the incentives, and so it's not just that we're building a protocol that's focused on one thing, but a very well-rounded team that brings specialization, to a lot of different aspects of the protocol.
Yeah, fantastic. Super diverse background, super impressive background as well, which makes sense for kind of what you guys have built. I'm always super excited to talk to you guys because I learned so much just with the amount of knowledge and everything that you guys have. So no surprise to see just kind of how impressive everything you guys have built is. So also super excited to talk about it again, especially with what you guys have done recently. So All right, very cool. Thanks for the intro. Really appreciate the kind of in-depth intro there, Darren. If you want to next just kind of give just a quick, 20,000 foot view of what Ipor is, and then we'll kind of dive into a little bit more and then get into a bunch of the project specifics as we go as well.
Okay, cool. Sounds good. So Ipor, I'll give kind of two views, right? So one side is the DeFi primitives view, and this is probably the side that most people are least familiar with, both in traditional finance and in DeFi. And that would be Ipor is an index protocol, as in, what is the risk-free rate or what is the cost of capital in finance right now in different markets. It's also a derivatives platform, which is focused on interest rates and staking rates. And if all of this kind of sounds like voodoo to you, then let's take it the other perspective, right? These two things are really what something like a home mortgage is built on, right? So if you go to a bank and you want to take out a home loan, the bank's going to ask you, do you want a fixed rate or do you want a variable or a floating rate? And you can choose one or the other. So what's happening in traditional finance is they're giving you a quote off of the market rate. What's the cost of capital, right now, and they're taking a derivative on the background if you want to basically take a fixed rate. And this is how the instruments are constructed. So then if we apply that to Ipor, there's some different smart contracts that run different parts of the thing, but the core of it is, let's say, an interest rate derivative protocol. This is very good for risk management. It's something that can help create fixed rate products in DeFi. So let's say if you want to borrow USDC for 1 year at 5%, for example, that might be an outcome of what you can get by using the interest rate derivatives in Ipor. And then if you think on the product side, maybe you're looking to take that fixed rate borrow. Or you can also think of some of the product sides that we have coming up, which is, let's say I want to put my ETH to work somewhere. I want to, let's say, leverage the difference between the ETH borrowing rate and the ETH staking rate, and I want to fix this kind of income on leverage looping for a certain time. So maybe you can construct like an Ethereum vault, which has pretty low risk and it is yielding 10 to 15% per annum. Well, that's something that you could build on top of the Ipor protocol. And why we chose this is because we're really looking at traditional finance and thinking what's missing in DeFi. So if we look at traditional finance, we see that the largest market in the world is forex, or foreign exchange, right? And if you look at the second largest market, it's interest rate derivatives, 450 trillion to 600 trillion notional every year, and this is the derivatives market that underpins the debt markets. And so this construct is massive, but it's non-existent in DeFi, right? So in DeFi, we're really looking at asset speculation. If you talk about, the mostly dominated by the perpetual protocols, you have the options, you have different types of ways of speculating on assets, but you have about half of DeFi's activity, which is centered around the credit markets. And this kind of deep derivatives market on the other side is mostly missing, right? Right now, you really have the emergence of Kindle as one of the market leaders there, and Kindle really focuses on this kind of bond coupon market where you can buy, let's say, a future asset at a discount. This is some play on can't forget the remember the principle, but I mean, it's basic. Sorry, time. It's a different way of playing the time value of money. And then you have something like the interest rate derivatives, which is a role that Ipor fills, and that's really focusing on capital efficiency and leverage. And you can also get a lot of different trading strategies there in the interest rate market. So everything's really deep asset speculation in DeFi. Very few things are looking at the credit market side. And this is a greenfield opportunity. And it's also something that adds structure to the market, and that will help it will help not only the DeFi credit markets grow, but also DeFi in general.
Yeah, fantastic breakdown. Yeah, this is something that we've kind of talked about before was the lack of the derivative aspect of this that's in DeFi. And so, with it being such a massive part of traditional finance, like you said, between 4 to 6 trillion, what are kind of the catalysts that you think that we really need to see within DeFi to make this market kind of grow, to drive this narrative?
Yeah. Actually, 400 to 600 trillion.
400 to 600 trillion. My apologies. Yeah.
It's a big. No, I mean it's a big market. It's hard. It's hard also to remember and to understand. Like, in general, we as humans are bad with large numbers because we see anything over, let's say, a million as as equal. But it's just a ridiculously massive market. But the reason it is because I mean this is the market that. So in finance, cash is king, right? Cash is king, and that's why everyone's looking. That's why the forex markets are huge, the debt markets are huge, the interest rate markets are huge, and they drive all of the other markets, the commodities, the stocks. But in DeFi, we care too much about our asset speculation and not enough about our credit. It's not that the asset speculation isn't valid, but we need this kind of leveling of, kind of our senses. And this is, I think, something that's maybe interesting where you have more sophisticated players that are coming in. So if we step back and we look at crypto cycles, each crypto cycle, let's just take the Bitcoin price, right? The peak to trough gain is always less. Also, the drawdown is typically less. And so you're seeing kind of less volatility in each cycle. You're getting, I mean, the market cap is much larger, but you're getting in more sophisticated players. So that should bring about more kind of market stability, right? So, crypto is still, extremely volatile, but it's getting less so over time. And I think this shows kind of market maturity. And it's market maturity because you have more sophisticated actors, because you have more actors, and it's more entrenched in the mainstream. And I think, and I hope, and I believe that this kind of behavior will also happen in DeFi, especially in the credit markets. But it's not just like hoping that it will happen is the right way to develop markets. You actually have to build the tools. So we were looking at the tools that are missing, and it's this kind of idea of what's the cost of capital and what is this kind of basic instrument, to basically manage your risk, in the interest rates. And this was, this was a huge market opportunity. But actually, one of the other catalysts is that, the Ipor protocol has recently launched a new instrument. So before, when we first spoke, it was underwriting stablecoin, the stablecoin swaps, interest rate swaps on the three indices, USDT, USDC, and DAI. Now, actually, the one market that has the most uptake right now is the stake rate swap, which is for what is the staking rate on Ethereum, and the first one is for the Lido stake ETH rate. And so this is actually a place where I think DeFi native people really care a lot about. They really care about their sweet ETH on ETH yield. A lot of people believe that the staking rate is the true risk-free rate in DeFi. And so this instrument may have, and we're seeing has a very good product market fit within the DeFi community. So I think a lot of these things, one, having this DeFi native Ethereum stake rate swap. Two, having more sophisticated players, more people that are serious about risk management. And three, the growth of the industry will be some catalyst that will drive traction in bringing in basically the increase in market share of the interest rate derivatives and stake rate derivatives in DeFi.
Yeah, I was actually kind of super excited to kind of talk about the stake rate swaps there. Could you? I guess could you kind of do like a? I mean, how does that work exactly, right? So I was bouncing around the dashboard, kind of trying to figure out is this swapping between rates on like different platforms that people have staked, or how does that work?
No, I mean, okay. So in general, when you stake Ethereum, you can get you get some yield, right? You have the different big stake pools like Lido, like Rocket Pool, like Coinbase, and they run a set of validators. I mean, similar to why you would join a mining pool for Bitcoin, because you have a greater chance of success. You basically what it's reducing variance in the payoffs. And so, there's been a couple of different indices. Like there's the composite Ethereum stake rate by CoinDesk and CoinFund, which is saying, okay, so what's the yield across all Ethereum validators? That's not really true because you can't really delegate to a pool, or if you're an individual delegator, you won't get that rate. It will vary, right? So what we're doing here is actually underwriting the Lido stake ETH rate. So it's the largest liquid staking derivative pool in DeFi. So they have a large set of validators. Each one of those validators participates. They pool the capital and they distribute it pro rata amongst the stake ETH holders. So there's some magic that we do there. So Lido prints the rate once a day on chain. And so, you can see on the chart, if you look on the Ipor app on the stake rate swaps, there's a little white dot, and that corresponds to where the rate was printed. That's the average APR on the staking side for the past 24 hours. It's called a look back window. And then we go into kind of the data pipeline with the engineers that we have on staff, whether we call them the kind of the data wizards. And what they do is that they actually look on chain and they're able to calculate this at the epoch level. So every I think 6.5 minutes, we're able to calculate within a very, very close level of accuracy what the lighter staking rate is every 6 minutes. And so that's what you're actually trading. So it gives you not only the data transparency, but also the venue to day trade the Lido stake ETH rate. So that's what you're trading there. And from an instrument perspective, it functions very similar to the interest rate swap. So you get a quote, you go in, you say, okay, I think the rate is going to go up, or I think it's going to go down over the next certain period, 4 weeks, 60 days, 90 days, right? So what you do is you go to the app and you select the pay fixed or receive fixed, and the AMM will give you a quote. It'll give you a fixed rate, and if you like this fixed rate, you think, okay, so it's quoting me 3.4% on a pay fixed. So my calculation is basically over the next, let's say, 28 days, I assume that the rate will be above this level. So this is where I'm putting in kind of my profit calculations, and I'm saying, okay, if the average rate over the next 28 days is above 3.4, then I'm in profit. Or if you think it's going to be below, you take receive fixed. And so it functions very similar to an interest rate swap, but there also is the data magic for getting the lighter stake rate from off-chain. I mean, basically calculating using the on-chain and being able to trade that intraday.
Very cool. Okay, that makes a lot of sense now. Yeah, awesome. Thanks for like the thorough explanation there. And then one of the questions that kind of pops in my head is like, what's kind of like the minimum, kind of bag size where this like kind of makes sense to make these types of trades?
Yeah, well, it depends. It depends on really what your goal is. Also depends on your level of sophistication. So, I mean, if we talk about the Ipor protocol in general, there's different users. Sorry. So, you can think of it like, okay. So first of all, interest rate derivatives, stake rate derivatives, which are a new construction, they're very sophisticated financial instruments. So I'm guessing that the vast majority of people will not actually be trading them or using them. So I think the vast majority of people will be liquidity providers, right? So what a liquidity provider, you can put Ethereum, stake ETH, or wrap stake ETH into a liquidity pool, or on the other side, USDT, USDC, and DAI. And basically what you're doing is you're getting a couple of different sources of income. You're getting income directly from the money markets. So assets are deposited into Ipor, Ipor deposits them into the money market. You get that base yield. You can also zap in, where you basically purchase and stake some Ipor, which gives you a boost on your liquidity provision. You can get fees from trading. So anyone who comes and trades, they're trading against the pool. So as an LP, you're a service provider, and you get some fees, and also the net outcome of the swaps, right? So it's a good place, and over the bear market, I think it was one of the top places in DeFi to park your stables to get some of the best risk-adjusted stable on stablecoin yield and liquidity mining. And now it's also a place where you can park your staked ETH and wrap. Wrap stake ETH on Arbitrum. And there are going to be a number of pools that are coming up in the next 1-2 months within Q1 that will bring new assets and new places to basically earn. So that's maybe the depositor side. If you're thinking on the trader side, if you want to go trade, you can. I mean, you can go, and one of the best places to do it is probably on Arbitrum right now, because of course the gas fees are significantly lower than on Ethereum mainnet. But also there will be an upcoming stake rate swap competition where you can earn Ipor rewards. Also, you can be profitable on your swaps. So this is a really nice place to try out, to learn about interest rate derivatives, also to earn on the instruments. But I think, if we're talking about future, if we're talking, let's say 6 months down the road, 1 year down the road, I think most people that will be interacting with Ipor will be interacting with it, not necessarily knowing what's happening under the hood, but it will be the vaults, right? So people are going to either they're going to be depositing, assets into these vaults, and they're going to be earning yield. Underneath, what's going to be happening is a number of different money market activities or credit market activities, plus swaps that basically take advantage, of different, of different market inefficiencies where people can take advantage of this and earn. So I think those are the three kind of user flows: depositor, trader, and essentially kind of these earn vaults.
Yeah, awesome. Okay, yeah, I think the stake rate swap competition is going to be pretty cool. Excited to kind of see how that plays out. So since you mentioned, Arb, that's one of the things I definitely wanted to talk about. Was I know you guys are in the middle of your rolling launch on Arbitrum. What was it that incentivized you guys to, move from Ethereum to Arbitrum? I know in our very first conversation, the reason for Ethereum was that the type of crowd you were appealing to was mostly on Ethereum, right? I know that you guys have made, major kind of upgrades to what you offer, but what was the key incentive at this time to start transitioning to multi-chain?
Yeah, I mean, we have a lot of community members that are really asking for it. Also, there's some governance processes, so this is important for how the protocol will expand. And the other thing is just basic gas fees, right? The gas fees they're a whales game. And so Ethereum mainnet, I think, will always play an important role in the future of the protocol because that's where, at least for now, the liquidity is. So I think a lot of the large structured products will live on Ethereum. But a lot of the trading could move to the L2s, right? So this is also where kind of you get new communities. Arbitrum is an interesting one because it has probably the most sophisticated actors that are trading on it, and that's why you have this huge concentration of derivatives on Arbitrum. And it's really kind of showed staying power, at least for now. So people go, let's face it, on the L2s, people go farming, farm the airdrop and then move on to the next L2. But, Arbitrum has had some staying power. So because of its, very strong community, the gas fees, and also the governance, we had a lot of requests to expand specifically to Arbitrum.
Awesome, makes sense. And are you guys kind of waiting to see, how traction is on Arbitrum and how it plays out on one of the L2s, and like potentially looking at expanding to others in the future?
I mean, a lot of this is governance driven. But also it's kind of logic and liquidity,
Yeah.
right? So because it's a protocol that underwrites credit market activity, it probably doesn't make sense that you're going to have a lot of people being trading interest rate derivatives where there's no credit market activity. Mm-hmm. So I think and at least I hope the logic and the governance side goes that it will be requested for the protocol to be deployed where these kind of structured products are possible.
Okay, yeah, that makes sense. All right, and then yeah, so with governance, right? Something we love to talk about because there's so many different ways to attack governance and so many kind of failed models, but then also semi-working models, and no one's really, truthfully, nailed it perfectly yet. What are the governance factors on Arbitrum that you guys were looking at that made this so appealing?
Well, I mean, when I'm talking about governance right now, I'm talking about the Ipor DAO governance, and
Okay.
I can't remember how many, maybe 4 or 5 different votes have gone through Snapshot so far, and I think a number of them will be upcoming, in Q1 and beyond. But also, Arbitrum has done a very good job at incentivizing and keeping the activity around, right? So if we're talking about Arbitrum governance, the short, the STIPs or the short-term incentive programs were really popular and really a great way to, for protocols to kind of showcase their utility, for users to get some reward, which is also maybe a kind of a subsidy or an education cost for using them. And now they're talking about the long-term incentives pilot program. So that's also really attractive. It's my belief that these incentive programs should be designed to keep people in long term. That's the whole idea. So the kind of the mercenary capital or what it's kind of more like a locus. You come and you eat all the fields and then move on. That's really not useful for long term for the protocol. So I think Arbitrum governance trying to maintain its market share is pretty good. I mean, it's doing well.
Yeah, absolutely, it is. Makes a lot of sense. Okay, very cool. All right, so then I guess what we should definitely cover here is, since you guys have just moved to Arbitrum and have kind of an entire new set of eyes on your project and a new community. I kind of wanted to make sure that we actually cover what Ipor is, right? Like kind of how it's built more. So I guess first, if you wanted to kind of talk through the infrastructure of Ipor, as it relates to the index and the AMM liquidity pools and all that stuff.
Yeah, and maybe I'll turn it over to Dimitar because
Yeah,
you
absolutely.
guys are hearing me rambling just a lot. So
yeah, no worries. Come on up, Dimitar.
Sure. Okay, so on the infrastructure side, this is actually one of the reasons that we actually took quite some time to make sure that we really want to launch an Arbitrum. Yes, because the decision to launch Ipor is not, just like launching one smart contract and then everything is going. At all points in time, we need to make sure that we have perfect understanding of everything that is happening on chain, all of the MEV, all of the liquidations, all of the credit market activity, block per block rates, both for lenders and for borrowers, being able to handle, conflicting information when Ethereum splits into like 3 forks in a 15-minute period. So all of this is super important for us, and all of that is basically infrastructure that we have built in-house. So I think that if we are talking about like the sheer amount of data that we have about everything that is happening on chain, I don't think any other DeFi protocol even comes close. And of course, this is not to brag or look how much data we are collecting, but this is what makes our protocol work. Yes, this is what gives us the ability in real time to basically have a smart contract that in real time is going to price you an interest rate swap. In terms of the AMM, the AMM is very different from what you know from other AMMs. Yeah, so other AMMs for you is basically a pool with tokens inside, and there is some curve there which determines what is the price of one token against the other token. The Ipor AMM is a request for quote system, which means that the smart contract is willing to quote you a price for your interest rate swap at any point that you demand for it. Yes, and the price that the smart contract is going to quote you is based on all of that data that is being collected. Yes, so the smart contract basically gets feed from the oracle of what is the state of the credit markets, what has been the Ipor rate, what has been the moving average. The smart contract basically at the same time checks its own exposure towards a particular leg. So if you want to go pay fix, receive floating or vice versa. So a request for quote system is different than your typical AMM because it allows multiple things. So first, like if we are talking about pricing, yes, how the price is determined in an AMM, majority of the time is very inefficient. While a request for quote AMM can take so many multiple parameters into its pricing that you can actually, even with a limited amount of assets, you can basically allow for a lot of economic activity, simply because you have much better understanding, not only of, okay, what is the exchange rate of two tokens inside a smart contract, but everything else. What have been the average USDC rate on Compound for the past 3 months? What is the current interest rate and the amount of notional that the pool is underwriting at what specific rate, and how is that going to look after 1 or 2 months? So it's I would say much more complicated system, but I think it is the only system that can allow you to efficiently trade interest rate swaps at scale. The capital efficiency of the AMM pool is ridiculous. So a pool of like $2 million can underwrite something like 60, 70, 80 million dollars worth of interest rate swaps. And of course, if that pool becomes $10 million, you imagine you are going into the hundreds of millions of interest rate swaps. And the most special thing actually is that because the AMM itself is not like a two token structure when you are trading X against Y, that also means that all of the money from the liquidity providers does not need to sit inside the smart contract the whole time. It can be given out to different credit markets, as you know. This is how Ipor earns its some of its real yield is by having the money that are deposited by liquidity providers earn yield from the credit markets while they're also underwriting those interest rate swaps. And then the money is getting pooled if it is required to settle basically a profitable trader. And this is something that we really innovated on. I think that we launched this, and then a couple of months later, I think Balancer kind of launched something like that with a virtual AMM pool. But Ipor was, I think, the first protocol at scale that was utilizing 98% of the assets inside the protocol to continuously earn yield on other credit markets. And this is also something that in the future gives us a lot of flexibility of how to optimize the generation of yield. So, Ipor, knowing the state of the credit markets, the kinks, the current rates, the utilization, the amount of assets deposited in the different credit market, it really allows you to know, okay, I do not look at, Aave is giving 5% right now and Compound is giving 7% right now. That means nothing. You want to know if I deposit $10 million and I'm going to I'm going to keep them in a credit market for 3 months, where should my money be? And also not only where should my money be, but at which point does it make sense, depending on now the current state of the credit markets, to move that money to another protocol. And I think that this is something that for other people, it's very abstract. So of course there are some power farmers, yes, in the credit markets, but it's not that many accounts, to be honest. It's probably like less than 50 big scale DeFi power users of the credit markets, and the rest is like, mid-range, couple of 100,000 to 1 to million. But this is something that is very not known by retail, and I don't think that they're going to engage with it and basically try to do it manual. So this is where the concept that Darren was explaining before, it's like, I also don't expect that retail participants are going to be directly using interest rate swaps to help them build their own trading strategies or something like this. Of course, they can always speculate, but my experience is that they would want to deposit their money into the protocol that makes sure that that money is utilized the best and it gives them the best yield. And yeah, that's about the infrastructure and the AMM.
Yeah, great breakdown. Great breakdown. Very thorough. I'm not going to lie. I can't get over what you said about the capital efficiency. 2 million can underwrite 30 to 40 times that, which is just, to me, that just sounds insane. But yeah, it's just crazy. That's big numbers. You know what I mean? So, just crazy to think about, kind of like when you guys hit, if this were to reach even 10% of TradFi money, how much you guys are underwriting on such little capital, technically speaking. It's just that's good tech.
Yeah, that's the only way. That's the only way to do pricing for interest rate swaps. To be honest, if you cannot do pricing of interest rate swaps based on XY equals K.
Mm-hmm.
That's not going to happen, at least not at scale.
Yeah, absolutely. Yeah, that's crazy to me. I mean, you guys are, engineers and like all this other stuff with this crazy backgrounds. And so like, for someone like me to read that, it's just, amazing to see what can be done right in the space. And it's just awesome. So, all right, Demeter, so why I got you on, since you're the tokenomics guy, do you want to talk the Ipor token and then also Power Ipor and then kind of their role within the ecosystem?
Yeah, sure. Well, the Power Ipor is really born out of frustration with how much DeFi tokenomics are based on basically insiders trying to extract value from the system, and how difficult it is for retail users, for normal DeFi users to earn competitive yield. So I think it's a little bit too broad of a topic to cover all of it. But at the beginning, when we were building it, we basically had like there was one objective, and it was like, we want to build a protocol that no matter what happens, whether it's with the price of the token or with the amount of liquidity that is deposited inside, we want to give retail participants the ability to not be priced out of the market. Yes. So if you're familiar, for example, with curve tokenomics, or like for example V models, yes, you can get there a boost of like 2.5x if you have staked curve tokens. What you don't know is that in order to get a 2.5x boost, let's say if you have deposited $10,000 into the 3-curve pool, you need to have $100,000 worth of V curve in order to increase the yield of your $10,000 with 2.5 times. So to make your yield from 3 to 5%, you need to have $100,000 locked for 4 years. Yeah. So of course, this is something that Convex and other protocols after that went and they kind of like fixed by creating derivatives of the curve token, etc., etc. But for me, it was like, how can I know that this is not working? I know that this prices out people from being able to participate in DeFi. How can we fix that? So the Power Ipor token economics are quite interesting. I would not go into detail here. Just go and read it. It's in our documentation. It's very easy to understand if you spend like 5 minutes. But essentially, it allows you to boost your yield significantly. Let's say 3 times, 4 times, 5 times, 7 times, depending on how much exposure you're willing to take towards the Ipor token. So everything is like the ratio of the amount of capital that you're providing in the system, the amount of power tokens that you're delegating towards that specific pool, and you get a multiplier. And for example, like I said at the beginning, the objective was we want to give retail participants the ability to earn competitive yield in DeFi and I think that we launched in February last year. So from February until now, I think that the average yield that Ipor have returned on liquidity providers has been something like 40% consistently over 1 year. Some people have earned much more. Some people have earned in like the 80-90% yield, but yeah, that objective was achieved. And I think that, with new ecosystem coming and new pools that are going to be introduced to Ipor, Power Ipor is going to show really what it can do at scale.
Yeah, absolutely. Couldn't agree more. And so what I can actually do, everyone, when I'll make another post. The last time Demeter and I spoke, we talked in depth about Power Ipor. That was last day May. Man, when was that? That was a long time ago. Now that I think about it, kind of like right when you guys were launching that. But I will link that video in a follow-on post here, so you guys can go in and listen if you're interested in that, because it was a great conversation and just a great breakdown of how it works. So.
And because we're talking about Arbitrum here, yes, I'm just going to say that the average APR of the Arbitrum wrapped staked Ethereum pool right now is 180%.
180%.
Exactly.
Jeez Louise. That is like, is that with max max boost from Power Ipor?
Yeah, well, I'm not sure if it's with max boost, because I see that there are some people that are actually earning more than that. So it shouldn't be with max boost. With max boost, it's going to probably be higher.
Nice. Yeah. 180%
well,
APR. That's
the pool just launched, yeah. So
yeah.
Of course, if the pool goes up 2 times, it's going to drop down. But this again, this is where the Power Ipor dynamics actually start to play out. So let's say that right now a whale comes and puts 5 times more money inside the pool. Well, he's not going to be earning the same APR himself, because that would require him to have an amount of Power Ipor tokens that he literally cannot purchase from the markets. There isn't enough Ipor on the markets for him to be able to purchase them to give himself that boost. And this is part of what Power Ipor does. Yes, it allows for retail participants to be competitive with having small exposure towards the Ipor token, while, for example, if a mercenary whale wants to come and wants to farm the protocol, he cannot even obtain that much Ipor that is going to be required to boost his position enough.
Yeah, makes sense. And then just kind of a quick question here. Is there a max, just for everyone who's listening, kind of knowledge? Say I go in and I zap into the wrap stake ETH pool, start earning. Is there a minimum time that is it locked for a certain amount of time? Before I could pull my money out, or I could.
No, you can pull your money out instantly.
Okay.
There is no lock on that. There is a 0.5% withdrawal fee on the deposits when you want to withdraw from the pool, and this mostly is to really prevent certain tricks of like, okay, I'm going to deposit $5 million, and now the pool is going to be so much bigger. So if I want to take an interest rate swap, it's going to be cheaper, because the pool has a lot more capital. So the interest rate swap is going to be cheaper, and then I'll take it and I'll withdraw my money. So it's a small fee, but it helps for that specific use case, which is very difficult to control otherwise. Yeah.
Yeah, makes sense. All right. Yeah, I appreciate kind of the breakdown there. And then, the last thing I kind of wanted to get to, guys, before we cover community questions, which, by the way, Darren, I tagged you in kind of the original post just since there's comments within the conversation and then there to see if there were any of those questions you wanted to cover. I've been looking through them. We've covered a lot of the answers throughout. So I might have to do like a separate kind of thing for this giveaway if we don't have any different questions that we haven't covered. But the other thing I really wanted to just kind of get into is what is kind of your, I know you guys just launched some new stuff, but what is kind of your immediate, roadmap or next steps here?
Next steps. Okay, so there's a lot of big things that are happening, not just only in, let's say, the macro, both in crypto and in general, but also some big narratives that are happening inside of DeFi. So keep an eye out on a couple pools that are coming up, and those pools will be underwriting very specific instruments. I won't tell you what they are right now, but they do have to do with RWAs and liquid restaking tokens. And why those two particularly? Because if you think of interest rate derivatives, stake rate derivatives, and rates in general, that means that you have basically the cost of capital between different assets, and these assets are going to flow in different directions, based on where capital can find the highest yield. So, for example, RWAs, you'd had basically TradFi rates that were at near zero for a long time, and DeFi rates that were at 10, 20% in DeFi summer. Those completely inverted. You were getting around 1% in DeFi, 1.5% in DeFi. At the bottom of the last bear market, and getting 5% in TradFi. And now these are changing where the market's pricing in rate cuts, so you're going to get less in TradFi, higher in DeFi. So this allows basically capital to flow in from something like tokenized treasuries or tokenized money market funds into DeFi to try to get this higher yield. And so that's why that kind of new vault will be very important, or the new liquidity pool. The other liquidity pool is a liquid restaking token, and that will underwrite a different set of derivatives. But the liquid restaking is quite important because it's going to change what's the cost of essentially borrowing ETH. So if you thought that the stake rate was the risk-free rate in DeFi, well, you have kind of this risk premium that's potential on the liquid restaking, and you'll have this leverage looping flow that will be affected. So not only will it be a place where you can deposit into Ipor, get the Power Ipor rewards, but you can also get points and also future fees from underwriting different derivatives. So these are two things that are coming up. And then in the midterm, look for different vault strategies where you can just place assets passively and earn on them. And those, I think, are two things that I think will capture a lot of attention.
Yeah, I could not agree more. I was actually talking to somebody about this, kind of what, I was doing a little like dive through iPort and talking to a buddy about it. And we were talking about what you guys could potentially do with RWAs and liquid staking derivatives. So kind of funny that, you mentioned that. I'll have to tell Dow Chemist since he had to leave a little bit early, but I know he will be pumped to hear that news too. So I think that is a very smart move and will capture attention and a lot of liquidity as well. Those are two of the major narratives.
Quick plug, you guys also, if you're wanting to learn about DeFi, the Ipor intern in the regal attire, the Pepe Lord. If you're looking for lots of alpha, make sure to follow this account.